So Canada just canceled Black Friday for American retailers. Not reduced it, not taxed it, not imposed tariffs that made the deals a little less attractive or the margins a little thinner. Canceled it through a legislative mechanism so precisely engineered that Walmart, Target, Costco, and every American-owned retail chain operating on Canadian soil watched their single most important revenue day of the year disappear entirely, as though someone had reached into the calendar and surgically removed the one 24-hour window that determines whether American retail finishes the year in profit or in loss. The most sacred day on the American commercial calendar, the day the entire retail industry is named for, the day that moves companies from red ink to black, just got erased in America's largest export market by a foreign government that found the one vulnerability nobody knew existed and exploited it with the precision of a scalpel. Within 48 hours, Walmart's stock dropped 9.3% in a single trading session, the largest single-day decline in the company's history, not caused by an earnings miss, a recession, or a global pandemic. Target lost $14.7 billion in market capitalization before the closing bell. Costco fell 6%. Amazon's North American retail division withdrew its holiday revenue guidance entirely, citing what it called unprecedented regulatory disruption in a core international market. Combined, American retailers lost over $62 billion in market value in 2 trading days. Not because consumers stopped wanting to shop, not because demand disappeared, not because the economy contracted, but because a foreign government found the single day that American retail cannot survive without and took it away. And the spending didn't vanish. It was redirected. Every dollar that would have flowed through an American-owned register flowed through a Canadian one instead, producing record November revenues for Canadian Tire, Loblaws, Hudson's Bay, and hundreds of Canadian small businesses, while their American competitors bled out across the border. Warren Buffett, the largest individual holder of retail-adjacent investments in the history of American finance, a man who has built his career on understanding where value concentrates and where it is vulnerable, said this attack reveals something about American business that CEOs have been celebrating as a strength for decades when it was always, in every measurable way, a catastrophic weakness. But it's what Carney said when American journalists asked whether canceling Black Friday was going too far that is now being quoted by every retail analyst, every trade strategist, and every CEO trying to explain to their board why their biggest day just vanished. When you hear the mechanism, how you actually cancel a shopping holiday in another country, why Walmart and Target specifically were the targets, what the $62 billion in market losses actually represents for millions of American retirement accounts, and what Buffett says this means for every company that has built its survival around a single calendar event, you'll understand why this isn't a trade dispute. This is the moment a foreign government proved it could reach inside the American economy and surgically remove the single day that American retail cannot survive without. Hit subscribe because the holiday season is 8 weeks away and the damage is not going to wait. Let me explain exactly how you cancel Black Friday in another country, because the mechanism is more sophisticated and more devastating than anything the trade war has produced so far. And understanding it reveals a vulnerability in American retail's international business model that nobody had ever mapped until Carney's trade team found it and drove a truck through it. Canada passed emergency commercial sovereignty legislation, the Domestic Consumer Protection and Fair Competition Act, that imposed 3 interlocking restrictions during the 10-day window from November 20th through November 30th. The first provision imposed a 100% foreign retail surcharge on all purchases made at any retail establishment whose parent company is headquartered outside Canada. Not a tariff on goods at the border, a surcharge at the point of sale, meaning every single transaction at every Walmart, every Target, every Costco, every American-owned retail location in Canada instantly doubled in price for the consumer. A television listed at $400 at Walmart Canada now costs $800 at the register. The same television at Canadian Tire, which is domestically owned and therefore exempt from the surcharge, still costs $400. The math is not complicated. No consumer pays double when an identical product is available at regular price across the street. The surcharge didn't ban Americans from selling. It made buying from them economically irrational. The second provision mandated that all retailers operating in Canada during the restricted window must source a minimum of 75% of their displayed inventory from Canadian manufacturers or Canadian-based suppliers. American retailers, whose supply chains are built almost entirely around American distribution networks, American warehouses, and American product lines, cannot restructure their inventory in a matter of weeks. Walmart Canada's supply chain is optimized for moving American goods into Canadian stores. It is not designed to source 75% Canadian products on short notice, and the penalty for non-compliance is temporary suspension of the operating license for the duration of the restricted period. Retailers that cannot meet the threshold must either close their doors or face fines that exceed the revenue they would generate by staying open. The provision was announced 6 weeks before Black Friday. Enough time to be legally defensible as providing reasonable notice, but nowhere near enough time for any American retailer to fundamentally restructure a continental supply chain that took decades to build. The third provision was the one that sealed the kill. The Canadian government launched a federally funded Canadian Friday counter-promotion, a national marketing campaign directing consumers to Canadian-owned retailers. Backed by a $200 million advertising budget, celebrity endorsements, and a government-guaranteed price-matching program that ensured Canadian retailers could undercut any American Black Friday deal by at least 15%. Simultaneously, emergency advertising regulations prohibited foreign-owned retailers from running any promotional material containing the words Black Friday, Doorbuster, Holiday Sale, or any equivalent terminology in Canadian media, television, radio, print, digital, social media, and in-store signage. Cross-border e-commerce restrictions blocked Canadian IP addresses from accessing American Black Friday deals on Amazon.com, Walmart.com, and Target.com, and Canadian Customs imposed a temporary holiday period surcharge on all consumer packages shipped from American retailers. The three provisions worked as a single mechanism. The surcharge made American stores uncompetitive. The sourcing mandate made them unable to stock their shelves. And the counter-promotion redirected the spending to Canadian businesses before American retailers could adapt, pivot, or respond. And then the damage hit, and the speed and scale of it revealed something about American retail that Wall Street had been treating as a competitive advantage for decades. But that was, in structural reality, the single greatest vulnerability in the entire sector, the concentration of an industry's survival into a single calendar event. Walmart's 9.3% single-day decline wiped out approximately $41 billion in market capitalization. That number is not proportional to Walmart's Canadian revenue. Canada represents roughly 6% of Walmart's global sales, and the Black Friday window represents perhaps 20% of Canadian annual revenue, meaning the direct revenue loss from the cancellation was approximately $2.4 billion. But the stock didn't drop $2.4 billion. It dropped $41 billion. The difference, the $38 billion gap between the direct loss and the market reaction, is the contagion premium. Every analyst, every institutional investor, every fund manager who held Walmart stock asked the same question within hours of the announcement. If Canada can do this, who's next? If one allied government can cancel Black Friday for American retailers using commercially defensible domestic legislation, can Germany do it? Can Australia? Can Japan, South Korea, the United Kingdom, France? The market wasn't pricing the Canadian loss. The market was pricing the risk that the Canadian template could be replicated in any country where American retailers operate, which is virtually every country on Earth. One Goldman Sachs retail analyst wrote in a note that was circulated to every institutional client by noon, "The risk model for international retail is fundamentally changed. We are no longer modeling tariff risk and currency risk. We are modeling regulatory cancellation risk. The possibility that a host government can surgically remove the single most important revenue event from the retail calendar, that is a new category of risk. And we have repriced the entire sector accordingly." Target's damage was proportionally worse because Target's Canadian operations are more concentrated in the discretionary goods categories where Black Friday matters most: electronics, home goods, apparel, seasonal merchandise, and because Target carries the institutional scar tissue of its catastrophic 2015 Canadian exit, when it closed every one of its 133 Canadian stores and took a $7 billion loss. Target had re-entered the Canadian market 3 years ago with a leaner, more focused operation that was finally approaching profitability. The Black Friday cancellation didn't just cost Target its biggest revenue day. It raised the question of whether Canada was a viable market for Target at all, which triggered a second wave of selling from investors who concluded that a second Canadian retreat was now probable. Target stock fell 11% over 3 days. Its CEO issued a statement that managed to be simultaneously furious and helpless. "We have invested billions of dollars in Canadian operations based on the reasonable expectation that the rules of commerce would be applied fairly. A government-imposed surcharge that applies exclusively to foreign-owned retailers is not fair competition. It is expropriation by another name." The statement was legally precise and strategically useless because the Canadian legislation had been drafted by constitutional lawyers who ensured it fell within Canada's sovereign right to regulate commercial activity on its own soil. And no international trade body was going to tell a democracy it couldn't set the terms for retail operations within its own borders. The White House response was immediate, furious, and in a pattern that had by now become predictable, counterproductive in every measurable way. Trump posted on social media within 90 minutes of the legislation's announcement, calling it the most pathetic and desperate move any country has ever made, predicting that Canadian stores will be empty because nobody wants to buy Canadian garbage, and threatening retaliatory tariffs of 200% on all Canadian consumer goods entering the United States. The threat was empty, and every trade analyst knew it within minutes. 200% tariffs on Canadian consumer goods would raise prices for American shoppers on everything from lumber to maple syrup to seafood and agricultural products that flow south across the border daily, punishing American consumers for a Canadian policy that exclusively affected American corporations operating on Canadian soil. The retaliation would hurt Americans, not Canadians. And the White House economic advisors reportedly told the president exactly this in a meeting that, according to two people present, ended with Trump demanding they find something that hurts them, not us, and his senior trade advisor responding with a silence that lasted long enough for everyone in the room to understand that no such option existed. Behind the scenes, Walmart and Target CEOs were patched into an emergency call with the Commerce Secretary and the trade representative within hours. The call lasted 90 minutes and, according to executives who participated, produced nothing actionable. The retailers wanted the administration to pressure Canada into repealing the legislation through diplomatic channels. The administration wanted the retailers to publicly blame Canada rather than the trade war that had provoked the response. Neither side got what it wanted. One executive who was on the call later told a financial journalist in comments that were published within days, "We asked the government for help. They asked us for a press release. Our stores are dark. Our stock is cratering. And the best the United States government can offer is a communication strategy." That is the moment I understood that we are on our own. The CEO of a major retail industry association was more direct in a statement that was read on every financial news network by the end of the day. The American retail industry did not start this trade war. We did not escalate this trade war. And we are now paying the price for a trade war that was supposed to protect American business, but has instead handed a foreign government the most effective weapon ever deployed against American retailers. But why retail? Why Black Friday specifically? Of all the sectors Carney could have targeted, of all the pressure points available in 2 years of escalating trade conflict, why did he choose the one that sounds more like a culture war than an economic war? Because it isn't a culture war. It's the most precisely targeted economic strike in the entire confrontation. And understanding why requires seeing what Carney saw when he looked at the map of American economic vulnerabilities. Every previous Canadian trade action had targeted industries that most American voters never interact with directly: energy, critical minerals, port access, semiconductor supply chains. Those actions caused real damage, but the damage was abstract. It showed up in policy papers, in commodity prices, in supply chain disruptions that affected manufacturers but not consumers. The average American voter doesn't know what rare earth elements are, doesn't understand port logistics, doesn't track semiconductor supply chains. But every American voter knows Walmart. Every American voter has been inside a Target. Every American voter has either shopped Black Friday or watched the footage of the lines, the crowds, and the frenzy on the news every single November of their adult lives. When you cancel Black Friday for American retailers, you don't just cause economic damage. You cause visible, personal, emotionally resonant damage that reaches into every congressional district, every community, every household. Main Street damage. And Main Street votes. The political precision was devastating. Every congressional district in America has at least one Walmart. Walmart employs 1.6 million Americans. Target employs 400,000. When these companies' stocks crash, every politician who represents a district with a store, a distribution center, a warehouse, or a supply chain facility feels the pressure from constituents whose retirement accounts just shrank and whose neighbors' jobs just became less secure. Carney didn't just attack companies. He attacked the political infrastructure of American retail, which is woven into the economic fabric of every state, every county, and every town large enough to have a parking lot. And the cultural dimension made it worse. Black Friday is not a Canadian tradition. It was exported to Canada by American retailers as a marketing strategy, an American commercial holiday transplanted into Canadian culture for the explicit purpose of funneling Canadian consumer spending into American corporate revenue. Carney didn't cancel a Canadian tradition. He canceled an American one that was operating on Canadian soil, extracting Canadian money, and sending the profits home. That framing, extraction not commerce, is what made the policy politically bulletproof in Canada and culturally devastating for American retailers. And here's the paradox nobody in American business saw coming. The paradox that was hiding in plain sight for decades because the vulnerability it exploits was disguised as a strength. American retailers expanded into Canada aggressively because the Canadian market was everything an international expansion should be: large, wealthy, English-speaking, culturally aligned, geographically adjacent, and governed by institutions so similar to American ones that retailers treated it as a domestic extension rather than a foreign market. That ease of expansion created dependency. Canadian revenue became a structural pillar of quarterly earnings, baked into guidance, baked into hiring plans, baked into investor expectations. But nobody modeled the risk that Canada, an ally, a partner, a market so familiar that executives stopped thinking of it as international, could become hostile. Nobody stress tested for the scenario where Canada decided to fight back using the one tool that American retailers had no defense against, the sovereign regulatory authority that every nation possesses over commercial activity on its own soil. They built their most profitable international day on foreign ground and assumed the ground would never shift. The ground just shifted. And then Carney was asked the question. A journalist from the Wall Street Journal at a press conference in Ottawa, with Canadian and international business media filling every seat, said, "Isn't canceling Black Friday going too far?" Carney looked at the journalist for a moment, not with anger, not with defiance, but with the composed patience of someone who had anticipated the question and prepared an answer that he knew would travel further than anything else he said that day. Black Friday is not a Canadian holiday. He paused. It is an American revenue extraction strategy operating on Canadian soil. We simply ended the extraction. The room was silent, not the silence of shock, but the silence of recognition. Every journalist, every analyst, every trade official in the room understood that the sentence reframed the entire debate. Black Friday was no longer a consumer event that Canada had disrupted. It was an extraction operation that Canada had shut down. Within 15 minutes, ended the extraction was trending in 11 countries. Within an hour, it was the headline on Bloomberg, the Financial Times, Reuters, the Wall Street Journal, and every major Canadian newspaper. Within 24 hours, it had become the phrase that retail analysts, trade strategists, and international media used to describe the policy, not a cancellation, an ending of extraction. The reframe was the weapon, and it was more devastating than the surcharge itself because it changed how the world understood what Black Friday in foreign markets actually was. Warren Buffett's response addressed something that nobody else in the conversation had identified: the structural flaw in American retail that this attack exposed, and the universal principle that explains why companies that build their survival around a single event are the most fragile companies in any economy, regardless of their size. In 70 years of investing, Buffett said, I've learned one thing about risk that most CEOs refuse to accept until it destroys them. The most dangerous vulnerability is the one you build your entire strategy around, not the one you're watching. Not the one you've hedged. Not the one your risk committee has a contingency plan for. The one you've built your hiring cycle around, your inventory cycle around, your marketing budget around, your earnings guidance around, your stock valuation around. Because the thing you depend on most is the thing your competitor, or in this case, your host government, will eventually target. And when they target it, the damage isn't proportional. It's existential. Because you didn't just lose revenue. You lost the architecture that was designed to produce that revenue, and architectures take years to build and seconds to break. He applied the principle directly. American retail built its entire financial model around a single day. They called it their most profitable day, as though concentration of revenue were an achievement rather than a vulnerability. Concentration is never an achievement. Concentration is fragility wearing a tuxedo. It looks impressive during good times because it simplifies planning and maximizes efficiency. But concentration is the vulnerability because the more you depend on one thing, the more completely you collapse when that one thing is taken away. A company that generates revenue evenly across 365 days can survive the loss of any one of them. A company that generates 20% of its annual revenue in a single 24-hour window cannot survive the loss of that window. And a former central banker with a calculator and a knowledge of retail economics just proved it. The Berkshire parallel was precise and devastating. I owned a retail investment once, a company that derived 38% of its annual profit from the holiday quarter, with the majority concentrated in a single promotional event. I told the CEO, diversify your revenue calendar because any business that depends on a single event for survival is one disruption away from catastrophe. He told me the event was untouchable, that it had grown every year for 15 years, that consumers expected it, that competitors couldn't match it. 3 years later, a regulatory change in a key market eliminated the promotional window entirely. The company lost 22% of its annual revenue overnight and never fully recovered. He paused. When I hear retail CEOs say Black Friday is untouchable, I hear the same thing I heard from that CEO 15 years ago. And the lesson is the same. Nothing that exists on someone else's soil, under someone else's laws, subject to someone else's sovereign authority, is ever untouchable. His closing was one sentence, and it carried the quiet devastation that has made Buffett's simplest lines his most quoted. They built their most profitable day on foreign soil and forgot the most basic rule in business. The landlord always has the final word. He let it sit for a moment, then added something quieter, almost an afterthought that landed harder than anything else he said. And now every landlord in the world knows the rent just went up.